Hi, today I want to presenting the accounting for streaming content for Netflix. And the Netflix business model and case view, the business model fundamentals is that Netflix operates on subscription-based revenue model where subscribers pay monthly fees for unlimited access to streaming content. And the case study scope, this presentation examines two representative content transactions occurring in a single fiscal quarter. One is licensing an existing theoretical film and producing a original series. We will chase each transaction through accounting cycle, demonstrating how the fundamental accounting equation, which is the asset equals like liability plus equity, remains in balance throughout all journal entries. And the transaction one, which is the licensing content, for example, Netflix enters a licensing agreement for exclusive streaming rights to Blockbuster X, a theatrical release. The contract spans 24 months with total considering of 5 million. The payment structure requires 3 million paid immediately upon contract execution, with the remaining 2 million due when the content master is delivered and available for streaming. So we can see like there's a very clear assets now plus 5 million content asset and minus like 3 million cash, which the net asset will be the 2 million. The ability is the 2 million content payable. You need to pay for those content creation creator. The equity no change, which is net is zero. And for the transaction to producing original content, for example, like there's a production of Project Red Wolf season one. Netflix also produced a lot of original content. For example, original 10 episode series that which is the Project Red Wolf. During the current quarter, the company incurs 50 million into the production costs. They're including the cost compensation, director and the crew salaries, and the location and construction cost, and also post-production and the visual effect cost, and also like the music like licensing and the sound design, which the cash payment totaling is 35 million made this period with 15 million in production costs invoiced but not yet paid. So we can see the total production cost is 50 million, the cash outflow 35 million, accrued like payable is 15 million, which we think if the equity unchanged, the accretion balance the plus is 15 million on total. And transaction three, the revenue recognition and amortization. There's four steps like for billing subscribers and releasing content. The step one was is bill subscribers, charge monthly fee, and step two, defer revenue. There's create a liability for unearned service, and step three is recognize the revenue, earn the revenue as time pass. And step four is match the expense to consumption. So we can see here as an example, like the billing and the revenue um, for for current state. Yeah. Yeah, so there's like accuracy check and the common errors. The correct poetry achieved is the capitalized content asset when the rights are obtained on or production is complete. Some common errors like that there's could make and how to fix them would be expensing content immediately. Error two would be defaulting to straight line amortization. And error three will be skipping the default revenue. And we can see there's many error wrong approach here and some like corrections um, could be done to address these errors. Thanks for watching.